It's easy to justify taking high risk when your investment is going up, but when it's going down, that's when it truly shows how comfortable you actually are. There's no perfect or correct way to invest. It's more about aligning what fits with you. As a beginner, I think setting aside how much you can invest, even if it's a small amount, can go a long way. Have you been hesitating to learn about investing, or have been putting it off for all these years because you don't know where to start or don't know when is the best time to start? Well, once you're done with this video, you'll be walking away with more confidence on how to invest than when you first clicked it. And this is part 1 video of this 2-part series. If you didn't know, I sold off about $100,000 of my stocks a couple months ago, and now I'm in an exact position where a beginner would be if they were starting to invest, as I'm rebuilding my portfolio. So I decided to start from step 1 with you all, and maybe spark you to start your own investment journey. What is investing? How does it work? When we talk about investing in the stock market, it basically means you're investing in publicly traded companies that are listed on a stock exchange. Most of the companies that you may know of are usually public companies, but if you want to check, you can easily Google search the company name and write stock behind it. Popular publicly traded companies can range from Apple, Tesla, Amazon, Disney, Pepsi, and McDonald's. There's a bunch out there. When you invest in a company, you're owning a very small fraction of the business, which is called a share. The reason why you would want to own shares of a business is to either profit from the value of the company increasing or to be paid dividends for being a shareholder. A dividend is the amount the company pays you, usually on a quarterly basis, for your share of the company profits. This rewards you, the shareholder, for owning a piece of the company. With years of investing in high quality companies, you can compound your money endlessly without having to lift a finger, other than clicking or tapping the screen when you first buy the shares, of course. But this is usually what everyone discusses when they talk about passive income. Alright, so let's get into making a stock portfolio. The first thing we're going to do is define what the investment goal is for the money we're going to be investing. Basically, why are we investing? What's the purpose of it? Understanding this will help objectify and shape the investment strategy. This could range from growing your net worth, purchasing a home, a rental property, attending further education down the line, or a brand new car, which is probably not the best use of your money if you're young, but that's for another time. You gotta look to the future and see where you would want to put your money towards. For me, my goal for this new investment account is to purchase a home to live in. Next, we need to look at assessing how much risk one should be taking. Investing sometimes can feel like riding a roller coaster. There will be ups and downs, so one needs to make sure that they're comfortable with what roller coaster they're riding on. In other words, the level of risk they're taking on. There's a saying that goes, the higher the risk, the higher the reward. And I believe that's definitely true. When I talk about risk, I mean the type of companies you purchase. For example, you choose to put your money towards a penny stock hoping for a 100x return. Yes, that could be possible. But like I said earlier, the higher the return, the higher the risk. So with the potential of making 100x return, there's also potential of you losing all your money. Investing can sometimes be seen as a mental game. You need to be comfortable with the risk that you're taking, otherwise it could lead to you making decisions based on short-term emotions, which could be really bad. I have a couple stories of me making these mistakes when I was a beginner investor that could help you. If you'd like to see this type of video, let me know in the comments down below. It's easy to justify taking high risk when your investment is going up, but when it's going down, that's when it truly shows how comfortable you actually are. But that's not saying that you shouldn't be taking any risk at all. I'm just saying that you need to find the right balance, where you sleep well at night and are not constantly looking at the stock price. Personally, I want to be aggressive in my investment strategy, since I have the experience and the knowledge to do so. As you start researching about investing, you'll see how different people have different ways on how to invest. There's no perfect or correct way to invest. It's more about aligning what fits with you. Are you looking to be more active or passive? Do you want to just focus on dividend income, or are you looking for pure growth companies? Here's a little summary of the types of investing you can do. On the right side, we have value stocks, high yielding dividend companies. And on the left side, we have growth stocks. We have stocks that are in the technological sector. And in the middle, you can invest in the S&P 500 ETF, which basically means you have exposure to the top 500 companies in the US. And then there's also dividend growth companies. So with this, you get the best of both worlds. You're getting companies that are continuously growing their dividends. For me, I'm going for more of the hybrid approach, which you will see in part 2 of this video series. So make sure you subscribe to see how I go about it. The next part is which investment account to open. Alright, so when you first start off investing, depending on which country you live in, there are most likely registered accounts that the government has put in place in order for you to have some tax benefits when investing. For example, in America, there is the Roth IRA. In Canada, there's the TFSA, and in the UK, there's ISAs. Individuals should be focused on maxing these accounts for their investments before they look at non-registered accounts that are taxable. But these registered accounts usually have limits on how much you can contribute to the account on an annual basis. Side note, you know when the government sets a certain limit on something, it usually means it's a really good benefit, and you should be using the full amount. The whole reason why these registered accounts are so great is that it lets your money compound quicker, and for the most cases, tax-free. So don't let your money just sit there and do nothing. If you want your money to grow, you need to invest in certain investment products for you to reap the full benefits of these accounts. For me, I looked at this chart that Wealthsimple has created to help choose which registered account here in Canada is best for me in my current situation. I will link this chart in the description for you to check out if it's applicable to you. Based on my current situation, the conclusion came to me investing in FHSA, which is the First Home Savings Account. So what the government did is implement this program to help first-time homebuyers. In this account, you can contribute $8,000 per year up to a maximum of $40,000 in order for you to contribute to the down payment of your future home. The contributions that I make into this account are tax deductible, and then the investment growth in the account will also be tax-free. One of the rules for this account is that I have 15 years to use the funds in the account to purchase a qualified home. As such, this sets my time horizon for my investments to 15 years. I'm going to use a cliche line, but it works. Investing is like planting a tree. You can't plant a tree today and expect a full-grown tree the very next day. It's going to take a lot of time for it to grow, and by watering the tree, it'll help the tree blossom much faster. Just like the tree needs time to grow, you need time for your investments to grow as well. You can water investments by continuously putting additional funds into your portfolio to help the investments compound quicker. Alright, let's discuss how much we should be investing into the account. As I mentioned before, some of these registered accounts do have a limit on how much you can contribute per year, so that's something to take into account. Now, people have different methods on how they contribute to an investment account. Research says that lump sum investing beats dollar cost averaging. Lump sum investing means that you take all your investable cash and invest it all at once, while dollar cost averaging means that investing the same amount of money at regular intervals over a certain period of time, regardless of the price. For example, for the Roth IRA, the limit if you're under 50 years old is $7,000 per year. If you break that down, that's $7,000 divided by 52 weeks in a year, which is $134 per week into the market. Investing small amounts in the beginning will also allow you to get used to how the stock market works. And eventually, with experience being in the market, you will become more knowledgeable. As a beginner, I think setting aside how much you can invest, even if it's a small amount, can go a long way. For example, say if you're a college student or just entered the workforce. Putting away $134 a week may not seem much in the beginning, but it will add up. It will also set the habit of investing each week in your brain. And once you have access to more funds later down the road, you can bump up your contribution amount to something that you're more comfortable with, and then you'll see the start of the compounding snowball. One of the benefits most brokerages have nowadays is setting up automated recurring deposits into your investment account. This allows you to put money into your account without having any bias of whether or not you should be investing this week. It not only takes the hassle out of transferring over the funds, but also gets rid of the emotions. For me, I already invested $3,000 in my FHSA for this year. As such, I have $5,000 remaining space left for this year's total $8,000 limit. What I'm going to be doing is contributing the total $5,000 into the account and purchasing a money market fund. And then each week, I will sell off about $150 of the fund and purchase stocks. This will allow me to earn interest on the additional $5,000 tax-free rather than letting it sit in my high interest savings account where the interest is taxable. But say if there's an opportunity like a dip in the market, or if there is a company that I believe offers a better margin rate of return, I will consider putting more money towards that position. But it's all based on the current situation. While you're investing, it's good to stay informed about what's going on in the market, since it's always changing. There are a lot of factors that go in place, like the market sentiment, interest rates, and company news, that may affect your investments. Staying on top of things will help you make informed decisions and adapt your portfolio strategy as needed. However, keep in mind not to make decisions based on short-term emotions due to market fluctuations. Often, there's fear that comes into the market, where it seems like there's going to be an upcoming recession, stocks are going to drop 20%, there's a bubble in the market, etc. This will occur many times, but more often than not, the news story is usually short-lived, and the market will keep doing its thing. Something to note is that fear sells. This means that news channels, articles, social media, they overhype fear because they know people will look at it, since they would want to know what's going on and how it would affect them. News like this is something that I don't pay attention to, because I've seen it for more than 5 years now. I know how these news people operate. I just stay focused and stay the course. And often, when there is fear in the market, it usually presents a better buying opportunity. Alright, one more thing to know is how much you should monitor your account. As a beginner, checking on a daily basis is not the best thing to do because you're new to investing, there will be emotions involved since it's the first time you'll see your money going up and down, and you might make a decision based on short-term emotion, which will lead to making a mistake. For example, you might think all your stocks are not performing well, so you decide to sell them to chase stocks that are going up. But then in 1 month's time, you see the stocks that you originally purchased have gone up quite a bit, and your thesis of investing in those stocks were right all along. A good analogy I have is to think of it as you're owner of a business and you have some employees. You wouldn't want to overlook and micromanage your employees every minute of the hour. This will cause them to be discouraged and they probably won't be doing the best of work, which will overall hurt your business. You need to put trust in your employees to do good work when you're not there. So it's good to check up on your investments once in a while, maybe once a month or every 2 weeks in the beginning, but definitely you don't want to be checking it constantly. There's going to be ups and downs in the market, but you need to zoom out to see the long-term vision. Alright, so we have gone over the basics of investing. I hope you all have learned something and maybe enticed you to press that start button on your own investment journey. If there's any questions, comment down below and I'll help you the best I can. Give this video a thumbs up and subscribe to see the next part of this series, where I discuss the investment strategy that I have decided to do. If you want to see how I built my last 6-figure portfolio, check out this video right here. Until next time, stay locked in.